Hi, my name is Mike Mills and I represent the legacy team here at Equity Concepts. Today is Wednesday, September the 21st. We are entering the fall of the year, which is personally my favorite time of the year. This also means we're right in the heart of hurricane season. Fortunately, it's been a light year for storms off the coast, but the same cannot be said about the storms in the stock market. There are all types of economic, market, and geopolitical news and events taking place. We believe these can be intensified by talking heads, and if investors aren't careful, emotions can start to control investment decisions. Now, you've heard us say before that we invest for years and decades, not weeks or months. So while we pay attention to the news of the day, we don't allow it to dictate how we invest for you and your family's lifetimes. Early in my career, I worked for Franklin Templeton Investments, and I had the opportunity to hear from and learn from Sir John Templeton. Sir John was famous for many things, one of which was his 16 rules for investment success. Of this, rule number 10 is don't panic. And we agree, we cannot panic because of a pullback in the market. I'm reminded of this because since the COVID pandemic started in 2020, there's been an abundance of panic and many talking heads adding fuel to the fire. So where are we in the market? It helps to look back at the last few years and possibly longer. We began the spring of 2020 with a short bear market due to COVID and immediately had a recovery in the market. Recently, we confirmed entry into another bear market. And to be clear, it is a cyclical bear market that we believe we are in. The bear market and recession we had in 2008 and 2009 was a structural bear market. And these are brought on by a bubble in one or more areas. And a correction was necessary for the bubble to burst. In 08 and 09, this was a credit bubble. Structural bear markets are deeper and require more time for recovery. We do not believe we're in a structural bear market. In bear markets, there are things called rallies, and these are called bear rallies. We just experienced a nearly 20% one that started in June and ended in August. Bear markets on average do not last as long as bull markets, as can be seen by this chart from our friends here at First Trust. Bear markets are not the end of the world, and there are positive returns to find in bear markets. Often they require some repositioning of portfolios, which we've done, and more often they offer opportunities to invest for the long term. In addition to panic, talking heads can lead to investors trying to time the market. And we believe that time in the market rather than timing the market is a much better approach for long-term investors. You can see this chart from our friends at Lincoln showing time in the market. As we mentioned in our last video, diversification, including alternative investments, are a very important part of our investment philosophy, which incorporates public markets, private markets, and protection like annuities and life insurance. We've seen this year the low correlation of our alternative investments to the market has served our clients' portfolios very well. We're coming off a near decade-long investment mentality now of an acronym called TINA. TINA means there is no alternative. In this case, there's been no alternative for stocks. But now we're rotating towards another acronym called TERA. There are reasonable alternatives. To be clear, this does not mean we're abandoning stocks, but merely says that bonds and other asset classes are becoming attractive again. As an update on our public markets, we remain in favor of quality dividend-paying stocks over growth stock investments, but we believe growth should not be completely abandoned as a long-term investment. Many of our clients will notice our investment shift to dividend-paying stocks in their portfolios and a reduction in investments focused on growth stocks after this recent bear rally. In our bond funds, we know that we're in a rising rate environment, but we believe that much of the pain has already been felt in many fixed income asset classes. For long-term investors, we think this is starting to look like a good entry point for both equities and bonds. A word we have heard a lot in the news is the possibility of a recession. And yes, the technical definition of a recession was met after 2 negative quarters of GDP this year. But many would say we are not in a recession due to a remaining strong growth and low unemployment numbers. We tend to agree, but also think that we could enter a recession caused by the Fed marching ahead with rate increases. And if so, we do not believe it would be a deep recession. The last thing I'll touch on is inflation. Inflation is affecting nearly every segment of the market and our lives, from the cost of energy to food cost and wage inflation. We believe the Federal Reserve will focus solely on reducing inflation until they believe it is under control, even if it means more pain in the economy and the market, as Fed Reserve President Jay Powell has suggested in recent comments. We also believe that inflation is going to be with us a bit longer than we all would like, but is already starting to show signs of easing in certain sectors. Overall, we believe more volatility is ahead in the public markets, and we're likely to hear plenty of noise from the media and market analysts. However, we're not going into panic mode, and chasing every market win. Instead, we're focusing on the long term. After all, storm seasons do pass, and we expect this one will as well. As always, if you have any questions, please contact any of us from the Legacy team here at Equity Concepts, and happy fall.